We have the founder of Strategic CFOs, Ed Gines, here today. Ed Gines worked with early stage companies. He's been in Silicon Valley for a number of years, helping them get ready to either be acquired, raise financing, or just get to the next step. So you're in for a treat today on Silicon Valley Successes.
Welcome to Silicon Valley Successes. We interview experts and entrepreneurs to give the world access to the knowledge and experience that is here in Silicon Valley. Our mission is to create opportunities for those who seek them and help you to become the next Silicon Valley success.
Ed, welcome to Silicon Valley Successes.
Thank you.
Could you please give an introduction to yourself for everyone at home?
Absolutely. I'm Ed Gines, Strategic CFOs. I have staff here domestically, U.S., as well as internationally over in the Philippines.
Interesting.
Yeah. Two areas we concentrate on: the CFO component of the business, and then our staff is more of the accounting services, the nuts and bolts of the business.
Wow. So Ed, quick question for you. I just want to go right into it. When a company comes to you,
Yeah.
what are their normal problems? An early stage company, they say, okay, I need help. I'm going to contact Ed. What's going on?
Well, I've seen this as like the 3 C's. It's compliance, cash flow, and clarity. Clarity meaning the financial statements. Oftentimes you read it and you go, what is this? An investor needs a little bit more than just saying, what is this? They need the financials to read a story.
Okay.
Part 2, cash flow, right? What's our burn rate, for goodness sakes?
Okay,
When
so what's
yeah.
a burn rate?
Well, how much cash are you guys going through on a monthly basis, and when are you going to run out of cash?
Okay.
Because you better get your next round of funding done sooner rather than later and prep for it. So if your burn rate is $100,000, you better have $800,000. If in 8 months you're done, right?
Really?
Yeah, it's that simple.
So if I have $800,000 left in the bank, when should I really start thinking about raising more money then? If my burn rate is $100,000 a month?
2 months from now.
2 months,
At the
so
latest,
6 months?
6 months. Get ready, because it takes a while to get funding, because you're beyond friends and family at that point.
Okay.
And now you've got your Series A, your Angel. There's a number of procedures that have to take place. And just kind of going back to those 3 C's, the compliance part. Another part of the business that can really knock the business silly is compliance, which is government filings.
Okay.
We all are
excited. What mistakes
excited.
are people making there then? I mean, everyone knows what, March or May, sometime there you're supposed to file something.
Got to do a little prep work in order to get that. You mean the filings of the corporate returns and the extensions. That's what you're referencing, right? But not only that. I mean, you've got sales tax out there, depending on the type of product.
Okay.
I know there's SaaS companies out there, how we're recognizing the revenue so that if you're even generating revenue, right? In terms of, on these SaaS companies, are you amortizing?
First
getting
off,
a little fancy,
what's
right?
SaaS?
It's a fancy word for software as a service.
Okay.
Yeah, and there's a lot of startup companies here that are into the tech
SaaS
world.
model.
Yeah, exactly.
Okay, so
Exactly.
so an early stage company, they haven't raised, or they have 0 revenue. They're
Yeah.
not making any money.
Yeah,
They don't need to file taxes, right?
wrong.
Wrong.
Absolutely. We have to stay compliant. That 3rd C,
Okay.
compliance. Again, I use the words will knock the company silly.
Okay.
What it means is that all of a sudden, if you haven't filed your returns and you're trying to raise investor monies, you're already in the hole. They're not going to give you the monies because you aren't compliant with government regulatory filings.
Well, why would that affect an investor? Wouldn't the investor say, hey, he's not compliant today, we'll just get it done, he'll talk to Ed, tomorrow he'll be okay, then I'll write a check?
Yeah. No, those are, I'll give it to you in fancy words that I'll break it down. The government always has the first position. So if in fact there's monies owed, it's never going to go to the investor. It's going to be paid to the government first.
So then the compliance part is the investor worried about his money returning to him. That's why it's so important.
Yeah, and as a good CFO, you have to have those 3 things in order.
Okay.
3rd being compliance,
So-
cash flow, Because who wants an investor to run out of money from the company? No one does, right?
So who hires you then more often, the founder of the startup or an investor wanting to invest in the company?
Generally, founders is what I have as, and we're helping raise money. So we just did a $2.5 million round.
Okay.
Yeah, we
What
closed
stage
that.
company would that have been for?
Series A.
Really? 2.5 million Series A? How much equity was given up for that round? Could I ask?
Yeah, absolutely, you can. 2.5 over 25, so 10%.
What does that mean?
Yeah, sorry, a little fancy. So if the value of the company is 25 million,
Okay.
and they participated in giving $2.5 million, that's 10%, right? 2.5 over 25.
2.5 over 25. Interesting.
Yeah.
So back to that, the investor, what stuff is he looking for from you to make sure it's an okay investment?
Well, we're looking at the forecast. That's part of it,
And
and
the
believability of the forecast too. So
Okay.
we're testing the model to make sure that, hey, if we're going to go out in the street and raise this money, does it make sense? You really have to make sure that, in fact, are you projecting too high? Everyone wants the hockey stick,
Okay, the hockey stick
Yep.
meaning that. Okay,
but
that
in reality,
exponential growth.
has the company gone through proof of concept?
Okay.
Are they at commercialization? The hockey stick, commercialization.
So tell me a little bit about that with the startup wanting to raise funding. You said forecast. The forecast would be for the next 6 months, next year, next 5 years.
There you go.
What's a forecast?
Yeah, the 5-year. It should be
5-year.
detailed. And the way we structure it, first year or two, you show it on a monthly basis. You also
Okay.
can show it on a quarterly. But years 3, 4, and 5, that's on an annual basis. But we still forecast it correctly, but you don't want to overwhelm your investor with all of this minutia detail. You have to be able to express those financials to tell a story. And on years 3, 4, and 5, the story gets a little bit, rosy glasses a little bit. Oftentimes, investors are cutting it in half.
Really?
Absolutely, for valuation purposes, right out the gate.
So on that year one, that forecast, what's it kind of based on? What type of information is normally given to prove that it's a possibility that this forecast is real?
This is great. Good stuff. So we happen to be in December of 2018,
Okay.
right? January through November, historical data already for the company. So that's not part of the forecast, but that's the reality in
Okay.
order to build what does it look like in December, and then 2019 building it out forward for the remaining 4 years and 1 month.
Okay, so you take the past year or however much time you have, use that, look at the growth month over month, and then take that information and then do the same math for the next year, 2, 3, 4.
We go a little bit deeper in our forecast where we're building out the dev team, because it seems we're talking
Okay.
SaaS here.
Tell me about the dev team's just the
Ju-
engineers
yeah,
making the
engineers,
product.
Correct.
All right,
And
the
so
dev
we're
team.
we're just talking about headcount. How much more do you need in terms of building out the next generation, et cetera?
So questions like that, you would go to the investor and go, I need 4 or 5 more engineers. That's why I need this much money.
Correct.
Okay.
Because the burn rate is increasing at this point in time.
And the burn rate is,
As again, it's expenses. A lot of these dev guys and ladies
okay.
need to get paid. They're not living off of equity. They can't cash in their stock options, right? You can't put that on the table and eat it,
Okay.
right? So part of the burn is the expenses of paying for your development team.
And burn, and there's a term used earlier, runway.
Run rate?
Run rate. How are they related?
Well, I'm thinking of it this way in terms of growth, if that's where, because I don't recall the word run rate, but that's okay.
Oh, maybe I made that
That's
up.
okay. That's okay, Sean. So the run rate is what's your burn rate as well as what's your growth rate too. So,
Okay. Interesting. So, Ed, question for you. I know you have a bunch of examples that you talk to people about how you work with them and use cases. There's a few that I remember. One of them was cleaning up the paper blizzard.
Yeah.
Could you talk about that?
Well, yes. Ideally for me, our office is paperless,
Okay.
which is it's a high goal. But if oftentimes you go into the startups, papers everywhere, it may be electronic, but you have to start sorting things out the right way so it's accessible to build the data room necessary for investors, because they're going to be asking for those documents, supporting documents.
So then the data room is what?
It's a build out.
It's a build out.
It may be equity related, debt related, it could be expense related. It's just different areas of the financials that you need to support. Why did we have this transaction? What is this expense? Click, there it is.
Interesting. So with that, does that mean paperless, meaning I can just put everything in QuickBooks and then we're done?
Two things. The data room is external to QuickBooks. A well put together audit capability is that there are attachments to the accounting software. We just happen to use a software called QuickBooks.
Okay.
So yes, data room at a higher level, transactional over at the in QuickBooks, so that it's very easy to find.
Okay. And going back to when a startup comes to you, he doesn't really know what he's doing. Should he hire a bookkeeper or accountant? At what stage? Either or. Because, I mean, I hear that a lot. Should I hire a bookkeeper? Or should I hire a CFO or a controller or all those?
Well, I think it's a migration. It's a path of evolution.
Okay.
So a bookkeeper would come in nicely initially just to get a little bit of organization.
And what would that bookkeeper do?
Well, make sure that all the buckets are in the right place. A lot of bookkeepers, though, aren't looking at it from a CFO's perspective. So a bookkeeper comes in, they go, oh, here's the expenses. And the CFO is going, no, we really should have cost of goods direct and indirect. We should have in the operating expenses area, the operating expenses being operations, G&A, sales and marketing,
Okay.
R&D, right?
Research development.
There you go.
Okay. So the bookkeeper would more input the data, and then the CFO would look at it and go, really, let's put this here, let's put this there, and kind of manipulate it around.
Yeah, and at that early stage, fractional you don't need a full-blown horsepower CFO. You just need someone to oversee that the bookkeeping is correct.
So that CFO could actually be someone that comes in a couple hours a week and just looks, or maybe 10, 20 hours a week, and just looks over the work that the bookkeeper did. Is that a common thing startups do?
It is, and I'll go back to the one that I'm thinking about right now. They called me for the forecast, and they go, you have no books, and you incorporated in April? And I'm like, this is complex. Okay, so it took a little bit of myself and my team to get the financials ready for that $2.5 million raise.
Interesting. Wow. That company
that came
grew
from
quick.
zero to the raise.
25 million valuation in 6 months, 7 months.
Well, they've been building on it, but now that investors are buying into it. And so they're already in production and bringing in revenue.
Good for them.
Yeah, lucky them. Yeah, and I'm part of the team.
So congratulations on that. Next question for you then. I've heard the term controller. How does a controller work with the CFO bookkeeper? What's the difference? What's the similarities, or what's the defining role?
My pleasure. So a controller to me is a high horsepower bookkeeper, because they're making sure all the buckets are right. The expense buckets, if there's revenue buckets too. So they're more qualified than a bookkeeper, but they're looking at historical information. Whereas on the CFO side, we're looking more forward and strategizing. What do we need to do? What's the head count that we're going to be doing going forward? What kind of a business model are we building? Whereas the controller is just making sure, are we representing history correctly?
At what stage would a company have a CFO, a controller, and a bookkeeper?
Wow. I can fill both roles of CFO and controller.
Okay.
If there's three of us, that's too much on the management side, in my opinion.
Interesting.
You just need a controller that might be able to do some CFO work, but that controller must also be able to do the road shows too, to bring in the...
What is a road show?
Yeah, sorry. Road show is when we're going out with the senior management team and raising funds.
Okay. In that raise and fund presentation, how important is the controller
Or the CFO.
or the
yeah.
CFO in that presentation.
The easy way to say this is adult supervision.
Okay.
We have to laugh, right? We have to laugh. But they want to know who's managing the funds for that's just been brought in. They
Okay.
want it done correctly. A controller might be able to do that. And again, that's historical data they're working for and working with. Make sure, darn right, it's accurate.
Yeah.
But are we using the funds that are now in place to the best use of the investor?
Okay. Do any investors go to the startup and say, the funds you use, we think you've used them incorrectly. We would prefer you to use them in this area or this manner moving forward. And then the controller going, yes, no, or the CFO, yes, no. How does that relationship or conversation look?
That's a complex question. It really is. And I think it's a very fair one. We go through the board to make sure it's cleared if we're making some big moves, right? That's part of the forecast. That's the budget that we're putting into place. And that's just fiscal due diligence on my part to make sure that, in fact, what we said we would do based on the forecast on the milestones that are required, have we actually done that? So a CFO is in part of the board meetings, giving the investors comfort that we are making our milestones. And if not, why? Kind of important.
So then to change a little bit, there's two other examples I distinctly remember.
Sure.
The first one was the paper blizzard. The second one was preparing for raising funds. How would you, a company's been around 2-3 years, they want to raise their next round, they're a team of 4, pretty early stage, they come to you, how would you prepare their documents or their papers for raising funds?
Sure. Well, at some point in time, the financials have to be audited.
Okay.
Right? So we have
Would
another.
you audit them or someone else?
No, an audit in itself is someone who is external of the company, so that they in fact are independent. Whereas I'm more internal, right? So I can't audit my own self-prepared financials, but
That'd
that's
be
fair.
nice.
It'd be wrong, but yeah, it'd be nice. It'd be nice. So the fees are starting to go up too, right? Again, we're talking budget and forecast. Well, if we need an audit, put some more dollars down over in month 12 because we
Okay.
need to pay for that audit.
Interesting. So how, could you tell me some of the steps you use to help them prepare for going to investors?
Again, I back to the fundamentals, and then we'll go fancy.
Okay. Nice.
The data room, right? Building out, are we compliant? Have we met all the governmental requirements of making sure that we can run the business? We are running the business both at the city, state, federal level. Mind you, that's something that no one thinks about, but it's a necessary evil to make sure that the dollars can come in through the door from the investor. That one, financial statement presentation. Show a story. Show the story of what has happened and what is going forward. Those, those are over encompassing, but that's the foundation of what the financials need to show. Right.
Ed, this has been amazing information. And for more information, please visit us at SiliconValleySuccesses.com or visit us on Facebook or LinkedIn. But let's go back to Ed. Ed, preparing a company to raise money, how's it different than preparing a company to be acquired?
Wow. Acquisition mode. It's one and the same because you're starting to look at it from an investor's perspective. Is the corporation are we exchanging? Is this a stock sale or is this an asset sale? We don't even know, right? It got a little fancy.
It got a little fancy. Can you go with definitions, stock sale, asset sale, and who'd prefer what?
Again,
Twisted that one there
yeah,
for you.
I know. Oftentimes, what we describe as a stock sale, right? An asset sale often is when they don't really want the history of the company; they just want the technology.
Okay.
So they're just buying the assets and say the rest of it you guys can keep. It's cleaner for the acquiring company at times just to do an asset sale. It depends on what's important to the investor as well as to the founders too. So
Okay.
it's a really, I don't think it can be expressed in 30 seconds as to the advantage of one to the other. It's
Well, we'll
really,
get you back on the show then, and we'll talk mergers and acquisitions.
my pleasure.
Yeah. But let's go into a little bit more detail. So we've talked about a lot of things today. We've talked about early stage companies, getting them ready for fundraising to be acquired. We've talked about the 3 C's: compliance, cash flow, and
Financial statement clarity.
clarity.
Yeah.
We've talked about the interactions between investors and the entrepreneurs. We've talked about bookkeeper versus controller versus CFO, when you bring them in, the different stages, how they work together, the pony show, or however you like to call it.
The road show.
The road show, when they're going out to raise capital, and that confidence that's needed by the investors to see who's managing the money, more or less.
Well, they're not only they want someone on the back end, which is me, conservative, making sure that the monies are well protected for the benefit of the investors, but they are also looking at the CEO to make sure how believable is the story, how strong how far can this CEO take the company? They're often listening for the strength of the management team. It's not always about the financials. They come secondary, but they're looking at the CEO and saying, okay, how strong is your management team?
So that management team, how closely are they looking when it's a very, very early stage company versus maybe a little bit later stage?
Sounds like high risk on a very, very early stage, yes. Therefore, valuations are lower in risk reward.
So at the very beginning of a company, when it has no revenue, when it has no money, what are the investors looking for at that point?
That's seed right there. And oftentimes you're still at family and friends just saying, is this thing real? Is this proof of concept stage or earlier than proof of concept? How far along are you in terms of building a viable commercial grade revenue-driven company? That's far out there. Once you're there, it's a good feeling. A lot of companies, unfortunately, don't make it there.
So that early stage, when it's just friends, families, and fools, they sometimes say, what does that look like from the accountant or bookkeeper when they come in the picture and they found 20 people have written a $2,000 check each for the company?
Yeah, I bet you the paperwork's just atrocious already, right out the gate. So for a true investor to come in, that's got to be cleaned up.
What do you mean by cleaned up?
Executed documents, are there really stock purchase agreements in place? Are the minutes all put together?
Minutes?
Yes, yeah, and implying, do you have legal counsel already set up so that it is prepared for the true investor to come in? Because those early stage, they're just flying by the seat of their pants, just trying to make it, and paperwork is secondary, but at some point in time the paperwork becomes fundamentally important.
Interesting. Now, Ed, I heard you have something called the
Project Tracker.
Tracker? What is the Project Tracker?
It just keeps us, because we manage many companies, and for me to just go in and company A on Monday, company B on Tuesday, company C on Wednesday, I'm like, wait a second, I got to keep this all in track. What projects are we working on? Who's responsible? When's the start date? When's the end date? How much have we completed? And it just keeps moving forward. So it keeps us on track as to what does the company need. It's my report card. Have I done my job for company A on Monday? Because I got to flip my hat on and go to company B. What's that project tracker look like? It's not just one company, because as a fractional CFO, we need these tools in place to make sure that we are keeping track with each different project. One may be SaaS, one may be blockchain.
Okay.
The third one may be construction. Right.
So if you were a startup founder and there was Ed Gein sitting across from you. What information do you wish he would give you? What is the best information that you could give a startup founder?
Just make sure that you believe your product and keep moving forward. The compliance absolutely is important. The success rate, we all know the answer to that, right? Of all these startups. It's hard because if I overdo it for the compliance and they don't make it, why throw away the money? I'm being blunt.
Yeah.
Right? There's no reason for it. As we all know, success in startups is challenging already. I don't want to throw in horsepower unnecessarily unless it benefits the founder right away. But the bookkeeper initially, yeah, you need to get that straight because you got to pay your payroll.
So, Ed, can you tell the audience how to reach you? A summary again of what you do.
Sure.
And who your best client, your ideal client is.
Pleasure. So I'm Ed, Strategic CFOs. You know, we have two areas, CFO consulting and our accounting staff, both domestically and internationally, that help me see the project tracker Monday, Tuesday, Wednesday through Friday. Our ideal client, generally for one of our, we like working with 3 to 30 million and 30 employees or less, keeping it simple. The other one is startups, why we're here, working with founders that are at proof of concept, if not at commercialization. Series A, right in there.
And Ed, how can people reach you if they want to hire strategic CFOs?
Sure. Our website, Strategic CFOs, and there's a little hyphen between the two C's.com, and they can always reach me there.
Okay, so once again, that would be Ed at strategiccfos.com.
Yeah.
Ed, thank you so much for your time today. I learned a ton. I know everyone at home learned a ton. And next week on Silicon Valley Successes, we have John Bradley, who's the founder of an amazing company that's tokenizing real estate around the world. So we look forward to seeing you next week on Silicon Valley Successes.
Thank you from all of us at Silicon Valley Successes. We hope you found the information presented today useful in your path to success. For further information on accessing the resources in Silicon Valley, you may visit us on the web at siliconvalleysuccesses.com, on Facebook and YouTube. Thank you. And remember, we want to help you in your journey to become the next success.